Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about China Resources Mixc Lifestyle Services Limited Annual Report. China Resources Mixc Lifestyle Services Limited offers a diverse range of businesses and services to various clients in the People's Republic of China. The company operates through three main segments: commercial management business, property management business, and ecosystem business. Under its commercial management business segment, the company provides commercial operational services for shopping malls and office buildings, including pre-opening management and operation management services. It also offers property management and other services such as security, cleaning, greening, repair, and maintenance, as well as commercial subleasing services. In addition to these services, the company's property management business segment caters to families and residents living in residential communities, providing security, cleaning, and greening services, as well as repair and maintenance services. It also offers consultancy, preliminary preparation, pre-delivery marketing services, community lifestyle services, brokerage, and asset management services. Furthermore, China Resources Mixc Lifestyle Services Limited provides a range of ecosystem business services, including tenant sourcing and operation, venue leasing, event support services, and eco-services such as cell phone cosmetics, cultural operations, and other services. With its extensive portfolio of businesses and services, the company has established itself as a leading provider in the industry. China Resources Mixc Lifestyle Services Limited market capitalization of $109 billion is significantly larger than the average industry peer of roughly $1 billion. This shows that China Resources Mixc Lifestyle Services Limited holds a significant advantage in their industry. China Resources Mixc Lifestyle Services Limited trades at a higher price-to-earnings ratio of 24 times and a higher price-to-book ratio of 6.15 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The company maintains a moderate leverage profile, with liabilities making up 42% of total assets, suggesting a balanced approach between risk management and capital efficiency. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has expanded consistently over the past 5 years, with growth supported by rising operating income. This suggests the company is profitable and financially sustainable. The share count has remained broadly unchanged, indicating no significant dilution or buyback activity over the past 5 years. The company have a dividend yield of 2.43%. The income statement shows that the company have been growing its revenue annually and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth or decline for a company can be attributed to several key factors. On the growth side, an increase in other income and gains, decrease in marketing expenses, and recognition of revenue from operating leases are significant contributors. Additionally, rental income from operating leases is also a major driver of revenue growth. On the decline side, contingent rents not recognized as revenue until earned, lower of cost and net realizable value for inventories, and contract liabilities not recognized until customer pays non-refundable consideration or the company has an unconditional right to receive non-refundable consideration are primary drivers. Furthermore, residential property management services, commercial operational and property management services, leases of assets under contracts with customers, sales of goods and properties, and rental income from operating leases also play a crucial role in revenue growth or decline. The ability to manage contracts with customers, recognize revenue accurately, and navigate complex accounting rules related to contingent rents and contract liabilities is critical for the company's revenue growth or decline. By understanding these drivers, companies can make informed decisions to optimize their revenue streams and mitigate potential risks. The net income of the company experienced a significant increase in 2025 compared to 2024. The net income rose from RMB 17,154 million to RMB 18,022 million, marking an increase of 10.3%. This growth can be attributed to various factors, including a 5.1% rise in revenue and substantial increases in retail sales and rental income. The profit margins also witnessed a notable improvement in 2025. The gross profit margin increased by 2.5 percentage points from 33% to 35.5%, while the net profit margin rose by 1.1 percentage points from 21.6% to 22.7%. Furthermore, the core net profit margin saw a significant increase of 1.6 percentage points from 20.3% to 21.9%. The reasons behind these changes can be attributed to the company's growing revenue and increased income from various sources. The retail sales experienced a remarkable growth of 23.7%, contributing significantly to the overall revenue. Additionally, rental income from property owners saw an increase of 16.9%. These factors collectively contributed to the improvement in net income and profit margins in 2025. The company's financial performance indicates a strong ability to generate cash from its operations. According to the provided information, the operating net cash flow has exceeded the core net profit attributable to shareholders by a significant margin of 103.3%. This suggests that the company is not only profitable, but also generating substantial amounts of cash from its daily activities. As a result, it can be concluded that the company is indeed generating positive operating cash flow. The company's debt level has undergone significant changes over the past period. On one hand, the total debt increased by a modest 12.2% from RMB 9,061,230 to RMB 10,197,015. However, this growth is overshadowed by the substantial increase in lease liabilities, which rose by 12.6%. More alarmingly, the company's overall debt level skyrocketed by an astonishing 533%, jumping from RMB 4,426,000 to a staggering RMB 28,114,000. In contrast, the company's interest expenses have remained relatively stable. Finance costs remained steady at RMB 111 million, while interest expenses actually decreased slightly from RMB 115,881 to RMB 110,961. This suggests that despite the significant increase in debt levels, the company has managed to keep its interest expenses under control. The financial performance of the company's various segments and regions has been mixed in recent times. On a positive note, shopping malls have seen significant growth, with revenue increasing by 26.5% and gross profit margin reaching 75.9%. The CR land segment also performed well, with a 9% increase in GFA under management and a 3% rise in revenue. The office building segment was another area of strength, with revenue growing by 3.5%. Urban space also saw growth, albeit at a slower pace than some other segments, with revenue increasing by 12% year-over-year. The commercial management business and property management business were also notable performers. However, not all segments fared as well. Basic property management services struggled, with revenue growth of only -1.3% and a gross profit margin of 15.9%. Urban space was another area of concern, with revenue declining by 7.4% year-over-year. The value-added services to property owners segment also saw significant decline, with revenue falling by 26.3% year-over-year. Overall, the company's financial performance is a mixed bag, with some segments and regions performing well while others struggle. The company's dividend policy is a notable aspect of its financial strategy. According to various sections in the report, it is clear that the company has indeed paid dividends. This is explicitly stated on page 17 and reinforced by subsequent pages, including page 144, which confirms that the company has paid dividends. Furthermore, page 145 provides more specific details about the dividend payments made in 2025, highlighting both a final dividend and a special dividend. Additionally, page 224 reiterates this information, solidifying the conclusion that the company has paid dividends. Concerns about inventory buildup and supply chain disruption. There are valid concerns regarding the accumulation of excessive inventory, which can lead to significant financial burdens on businesses. One such concern is the high cost associated with holding onto large quantities of inventory. This issue has been highlighted as a reason for business divestment, indicating that companies may be struggling to manage their inventory effectively. The presence of excess inventory can also disrupt supply chains, leading to inefficiencies and potential losses. When inventory levels become too high, it can create bottlenecks in the production process, causing delays and impacting customer satisfaction. Furthermore, holding onto unsold inventory can tie up valuable resources, including capital and storage space, which could be better utilized elsewhere. In conclusion, the concerns about inventory buildup are multifaceted and far-reaching, with potential consequences for both businesses and their supply chains. Addressing these issues will require careful management of inventory levels and a focus on optimizing supply chain operations to minimize waste and maximize efficiency. That concludes the financial summary for China Resources Mixc Lifestyle Services Limited. Feel free to comment below, and I will be happy to answer them when possible.